Hi, welcome to Module 2. We started with Module 1 talking about the basic financial statements and their relationships. We talked about the balance sheet, point in time, not period of time, but point in time that we have valuations of assets, liabilities, and equity. We talked about the income statement for a period of time where we have our revenues, our expenses, and we have our profits, net income. We have a gross profit, net profit. We talked about our statement of cash flows, operating, investing, financing activities, and the relationships and how those kind of fit into a balance sheet when we're doing some analysis. We'll do a deeper dive on a cash flow statement because without understanding cash flow, you can fail pretty quick. So cash is king and queen in success of a business. But today we're going to take a deeper dive into two major areas. One is terms on the financial statements. We're going to dissect a balance sheet and income statement in much more detail. We're also going to take a deeper dive when it comes to GAAP, generally accepted accounting principles, and some of those principles behind GAAP. Why, when we buy an asset like inventory, does it not show up on the income statement right away? It sits as an asset, it's not an expense. Why do things like capital equipment, buildings, machinery, PP&E, property, plant, and equipment, why is that not an expense right away on the income statement, but starts out on the balance sheet? So I'm going to use a PowerPoint as a guidance, and we're going to take a deeper dive and do a walkthrough on some of the terminology. We talk about the language of business being accounting, and this is a language we're going to show and discuss. So I'm going to go ahead and we're going to talk about financial statements, our module 2 in the book. And the module 2, as we say, modules are like chapters in a book, but we term them modules. So as we do a deeper dive on financial statements, we're going to take a close look at the balance sheet. So what's on the balance sheet? Well, we know it's assets, liabilities, and equity. And the accounting equation, the core is assets equal liability plus equity. Hence the balance. Must be in balance. That's the purpose. That's the goal. The balance sheet has what are called permanent accounts. Well, what happens when we have a year end? Well, our revenues on the income statement go to zero. Our expenses on the income statement go to zero. But our inventory doesn't go to zero unless we sell it all. Our cash doesn't go to zero. Our accounts payable, the money we owe to folks, but too bad, but that doesn't go to zero either, nor does the equity and investments. But our revenues, expenses will zero out. Those are temporary accounts. But the permanent accounts show up in the balance sheet, and that's what we're going to be talking more about. So if we take a closer look, assets are things we own, was the basic definition, or what we also can term as future economic benefits. We're going to gain from this. We can turn most assets to cash if we choose, or we use them up. We can sell our buildings, we can sell our vehicles, we can sell our equipment, or we can use it up until it's fully depreciated, until the life is taken out of the asset. So there's future economic benefits associated with those assets. And there must be two conditions. Must be owned or controlled by the company and must arise from a past transaction or event. That means we're in control. We can sell it. We can use it. We can destroy it if we want. And we probably are going to insure it. So those are all things that we own and have control over. It's not somebody else's stuff, it's our stuff. Same thing for inventory. We're not borrowing the inventory, it's our inventory. And then they arise from a past transaction or event. Usually we buy it, sometimes we lease it. So let's go through some of the terminology. We have cash, currency, or bank deposits. That's the most liquid of stuff. Cash equivalents within 90-day maturity. So we might have investments that we can turn in, a 60-day note, 30-day note, cash equivalents that are very easily converted to cash if we so choose, or short-term investments, marketable securities. Apple stock, I can sell in 10 minutes. Google or Alphabet stock, I can sell in 5 minutes. Well, actually 10 minutes, whatever it takes me to go to the broker and take care of it or make the phone call or do it online. So short-term stuff, this current stuff that we're talking about within a year, technical definition within the year or operating cycle, whichever is longer. If we're Boeing and making Dreamliners, that's probably a 3-year process. That's the operating cycle. We'll talk more about that. But typically we use a 1-year point of demarcation. So that 1 year is going to be the magic that we will discuss. A grocery store isn't going to hold on to milk for a year. A clothing store is not going to hold on to bathing suits for a year. So their operating cycle is shorter. We're going to use that 1 year point of time to discuss our what are called, in this case, current assets that we're looking at. Net receivables. Like there's accounts receivable, money that we're owed, and the net is the amount we actually expect to receive. And receivables are when we make sales to customers and they owe us the money. They don't pay us the cash yet, but hopefully they will. Normally, you're not going to collect all of your receivables, although if you do business with the government, often, most of the time, you'll collect from all the receivables. But if you're doing business in public, not everybody pays their bills. Inventory or goods purchased or produced for sale. And then we have prepaid expenses. Well, it says expenses. Doesn't that mean it goes on the income statement? Actually not. It's a prepaid expense. We haven't used it up yet. We have prepaid insurance. We buy prepaid insurance December 15th for next year. Starting January 1st, we start using it up. What happens if our building burns down on December 28th? Are we going to keep a policy at full price starting January 1 for a burned down building? Hopefully our previous insurance policy will cover us, but we don't need to insure that building anymore. So we can get our money back in theory. How about planes? We bought a ticket, a prepaid plane ticket, and then the airlines go on strike and we don't fly. Well, we should be able to get our money back. Same thing with a concert ticket. We buy a concert ticket and we're going to use that for marketing purposes. We're going to give it to some of our best customers. We're going to take them or a sporting event, put them up in the box, the cool boxes with the good food, and then the teams go on strike. So do we get our money back? Yeah, we can convert that to cash, or we use it up eventually. That's an asset. We use it up and contribute to our benefit. Then we get some of the long-term stuff. PP&E, property, plant, and equipment net. That's net of something called accumulated depreciation. Over a period of time, we do depreciate that asset, sometimes going down to zero, sometimes going down to what we call a salvage value. And then we have long-term investments. So we might buy stock in another company, not our own stock, not selling our own common stock, but we're investing in another organization, another company. And that's stuff we're not going to probably sell within a year. And then there are intangibles, things we have rights to, patents, trademarks, copyrights, franchise rights. Basically, they're pieces of paper, but they give us certain rights. Every time somebody sings happy birthday to you, someone gets paid off. Happy birthday, Mr. President. Sure enough, if it's on TV, someone's getting a check or a transfer of funds. All right, so let's go take a look at how we measure these things. Well, GAAP says historical cost kind of dominates. That's the number you can hang your hat on. Well, why don't we just say, well, we bought a piece of property, bought a piece of real estate. It's appreciated. We paid $100,000 for it. Now it's worth $250,000. Well, someone else says it's worth $200,000. Someone else says it's worth $300,000. Somebody else says $225,000. Where do we hang our hat? Well, we paid $100,000. We know what we paid. That's where we can actually establish the value at the time of the purchase. Our books will show historical cost most typically, and that is normally not fair market value, by the way. So there's a really distinct difference. Even if our depreciating of assets, sometimes we depreciate an asset and the asset value on the books is not the asset value if I had to resell it. That's not the goal. So if a company can't value an asset with relative certainty, it doesn't recognize it on the balance sheet. If we can't quantify it, we can't show it. We're going to throw darts and guess. So we have, if means that significant assets are not reflected on a balance sheet. So sometimes not everything shows up on the balance sheet. IP, intellectual property, you've heard that term before, I'm sure. There are things that are going for our company. We've got veterans, 20, 30-year veterans in our company. We've got the best staff, the best trained, the highest quality of goods. We actually have the nicest oil fields, the sweet crude oil, none of that high sulfur stuff. Well, we can value it if we know what there's a dollar amount assigned to it. But some of the things like we have lots of customers and we've been in business a long time and we have a good reputation. If we can quantify it, great. If we can't, some of those things are not going to be shown on a balance sheet. It has to have a number associated with it. If we're looking on, we now go to the other side. We have the assets equals liabilities plus equity. Let's talk about our current liabilities. These are things we owe, or in this case, future economic sacrifices. And that's a good way to describe it. Two characteristics. It's an unavoidable obligation. We're going to have to pay it. We owe the money. We borrow bonds. We buy from a vendor and they give us credit. We have to pay them eventually. We have a utility bill. We put it on the books and we pay that eventually. Property taxes. Those are unavoidable obligations. And it must arise from a past transaction or event. And it's an amount that's going to be repaid. Can be interest bearing, like a bank, or non-interest bearing. We got a vendor who sent us a bill, the utility company, and we're going to write the check. Marketing. We're going to be advertising. We're going to be in social media, whatever it might be. Okay. Then we have equity. That's the asset equals liabilities plus equity. Equity has capital. It represents capital invested by the stockholders. So that means somebody has ownership interest, gave us some money. They either directly purchase stock or we have retained earnings. Remember that retained earning formula? Let's go draw that out because the retained earnings formula is pretty important to be aware of. So let's go into our whiteboard and talk about our beginning retained earnings plus net income minus dividends is ending retained earnings. So that is the ownership gets the benefit of the profits, but that's not the stock they bought. These are earnings that are retained in the business. So if we start with zero and we make 10 million bucks in profits, and we pay out $4 million in dividends, we have 6 million that is now retained in the business. The business is holding on to them. And that's one of the advantages. By the way, we know corporations have dual taxation. They pay taxes on this profit, and then the stockholders pay taxes on the dividends that are distributed. That's where the double taxation comes in. You never see the dividends on an income statement. Dividends are always coming out of retained earnings. You can't take our income statement and say, well, I've got sales of 100 million. I've got SG&A of 90 million. I've got 10 million in profit. And then I'm going to give out dividends of $10 million. That means I have zero net income. I pay taxes on zero, right? Isn't that a good formula? IRS will never sign off on that. So this dividend stuff is not on the income statement, but we'll get more of that. We'll see that shortly. All right, so I'm going to go ahead and I'm going to stop the share on this, and we're going to go back to our vision of where we're looking at finish off our balance sheet. All right. So we have our stockholders' equity, we have our liabilities, we have our assets. Now let's differentiate between current and non-current. Current liabilities, we have accounts payable. We owe the guys that we pay the money to, the folks that we pay money to, or we're going to pay money to for things we bought. We have accruals, accrued expenses, incurred but not yet paid. Okay, so accrued liabilities. So we think about that. We have and another word for accruals, by the way, is estimate. So we went ahead and estimated that we went to a trade show, and we've got about $100,000 worth of expenses that we haven't seen the time and expense reports yet from our employees that were at the trade show. But they spent the money. They stayed in hotels. They bought plane tickets. They bought food. They wined and dined our customers. They had stuff in trade show booths. So they had a good time. And the bar bill was pretty high, but we're still estimating it. We don't have a bill in hand. If it was a bill in hand, we got accounts payable. If the bill is not in our hand, we're going to accrue. Better to put $100,000 worth of liabilities on the books that we expect, and maybe it's 110 or maybe it's 90. But better to put the 100 on there than leave it at zero as an estimate. Unearned revenues. Okay, so we have monies that are on deposit. Let's say we're an architect. You come to me, I'm an architect, and you give me $50,000 to design a house. Well, if you move to Texas and our contract says, well, if I do the work, I get paid. If I don't do the work, I don't get paid. I owe you that 50 grand either in services or as a refund. If I do the services, I'm going to pick the 50 grand and put it into my revenues eventually. It's like my inventory goes down into expenses eventually. But if I don't design the house and you move out of town and contract says, it's voidable. If I don't do the work, you get your money back. I got to write you the check. Unearned revenues. Say, wait, the word revenues, that belongs on an income statement, right? The earned revenues do, not the unearned revenues. Then the short-term debt, we're going to use that 1 year mark again, same way we do with current assets. And then current maturities of long-term debt. How does that work? Well, if we have a 30-year mortgage or a 15-year mortgage, 1 year is the current portion. The other 14 years on a 15-year mortgage is long-term. What if we have 3 years left? We have 1 year and then current and 2 years long-term. So we have to divide that into 2 parts. Current and non-current are pretty important differentiators. Then we have our net working capital, current assets minus current liabilities. So if our current assets exceed current liabilities, we have positive working capital. So one of those liquidity measurements allows us to be able to determine, are we going to be able to pay our bills short term? We compare current assets and current liability. We'll talk about the current ratio in a little bit, which is current assets divided by current liabilities. If it's over 1, we're usually in decent shape. If it's under 1, we may not be able to cover what we need to. Net working capital is covering the operating cycle. That's 1 year, or the operating cycle is the current, or whichever is longer, but we're going to use a 1 year demarcation. That's a typical operating cycle. Get some pictures of the operating cycle. And we're going to say, well, it's when you go out, you buy stuff, you process the stuff, you sell stuff, and you collect the money. That's your operating cycle. Okay, so here what happens. We go out, get inventory, we sell it, we get cash back, pay our bills. That's a cycle. Okay, and taking a look, company buys inventory with cash and supplier credit, accounts payable. Then we go ahead and sell the inventory, use it for cash or receivables. Until we get the money as a receivable, cycle's not complete. So we get the cash from the receivable and we're good to go. That's the full cycle. It's called the operating cycle. It's the process. That's why when we talked about Boeing airplanes, that operating cycle takes over a year. Ballistic missile submarine, a boomer, that's going to take more than a year to build. That's a long operating cycle. You got to buy the stuff, make the stuff, produce the stuff, and sell the stuff. Operating cycle is kind of an important concept. Then we're looking at not the current liabilities, but our non-current liabilities. Again, we're going to use the 1 year point. We got long-term debt, principal that goes out there. Includes bonds, bonds payable, notes payable, debentures, basically bonds, mortgages, and other long-term loans. And then there are other liabilities or obligations like pension liabilities coming up in the future. Tax liabilities, settled a year or more into the future. Not current obligations, but future. Then we have our equity. We have our common stock and additional paid in capital. So if the stock is dollar par value and you buy 100 shares, that's $100 par value. But chances are you're not going to pay par value for a stock. You're going to pay market rates. So if it's dollar par is $10 market value per share, a buck of it goes into the stock and $9 goes into additional paid in capital. Preferred stock is preferred as to dividends. We're going to get more deeper dive in a future module, but preferred stock is a special status, not voting rights usually. Basically gives somebody preferential treatment when it comes to dividends. They're going to get paid first on dividends, but it's not really ownership interest. As a matter of fact, we'll talk about IFRS, International Financial Reporting Standards. Preferred stock is a liability for IFRS, but it's actually equity under GAAP. And we're going to be GAAP based, so we're going to talk preferred stock as equity. Then treasury stock. That's a negative adjustment. If we buy back our stock in the marketplace, there was the government that just passed some rules about taxing those buybacks, having additional taxes on stock buybacks. But company buy back stock for a variety of reasons, maybe to prop up the price or they think it's undervalued. But companies can buy stock just like you and me. So treasury stock is actually a deduction from equity. It's a negative. You have to pay cash, pay money out, because you could eventually sell. It's like almost like an asset at that point. You can sell your treasury stock, reissue it, and get buyers out there. Or sometimes you buy the treasury stock to pay off your chief executive officer, or as bonuses, or for employees, whatever reason, you're going to use that. Or you have stock options you've issued, you buy the stock back and then reissue accordingly. Then we have the retained earnings. You've seen that formula before, beginning retained earnings plus net income or minus net loss, minus dividends. The other thing we haven't put in there yet, stock repurchased and retired, both. Has to be both. Stock buyback, not to intend to reissue, but to retire. And you get your ending retained earnings. And then there's a term called other comprehensive income or loss. We've been looking at Edgar. We look at the statement of operations or income statement, but sometimes we have a statement of comprehensive income. It does not start with revenues, followed by expenses, followed by net income. It usually starts with net income. So that's not the income statement that we're looking at. So comprehensive income has some special meaning. It's where things might be on exchange rates, it might be derivatives, or some funky things that go into that. We're not going to worry about that right now, but we will do a deeper dive at some point. So common size balance sheet. Basically, when we look at a common size balance sheet, we've been doing that. We said we do Walmart and we say a common size balance sheet, we've got 2.5% of net income percentage. We might have 60% as a gross profit percentage or 40% of gross profit percentage, but that's with a net sales of 100%. On a balance sheet, our 100% numbers are total assets, which happens to equal total liabilities and equity. So that's going to be a 100% number at the same time. So either one of those, so inventory might be 40% of our balance sheet. Cash might be 20%. Receivables might be 30%. Fixed assets and equipment might be 60%. Might be 20%, depends on the business. So vertical analysis, also called, it's vertical is common size. We will talk about horizontal or trend analysis another time, but the common size balance sheet, we're going to have each line item expressed as a percentage of total assets. There it is. Every line item on the balance sheet divided by total assets. Makes it easier to compare. If I'm comparing Walmart to Target, to Kohl's, to Belk, if I said inventory is 30% of my balance sheet for Walmart and 40% of my balance sheet for Target, well, as a percentage of assets, well, Target has more inventory as a percentage of assets. How about did we do last year? Well, last year Target was at 35%. This year they're at 40%. That means they're having an increase. If you start looking at billions of dollars, you're going to get befuddled and baffled pretty quick. The numbers themselves are really hard to read and hard to understand. But if you have a common size, if you have a number that you can hang your hat on, makes it much easier to understand. So why compare across 2 or more years, 2 or more companies? Again, more easy to compare. And there are benchmarks for an industry. So there are industry standards you want to go up against. If you got 50% in inventory and somebody else in the industry standard might be 25 or 30%, you're kind of heavily weighted with inventory that might be bad, might be obsolete. There must be a reason why. All these statements tell a story, and you make interpretations based on that. Common size financial statements are pretty powerful to hear and understand. Then we got book value and market value. The book value is GAAP. And we said, wait a minute, GAAP is mostly historical cost stuff. But if we have a whole bunch of assets that have appreciated, we bought Bitcoin when it was $30, $70, $500, $1,000. Now it's $22,000. It's been as high as $40,000. And not too long ago, it was $18,000. If we have it on the books for historical cost at $1,000 a Bitcoin, and now it's worth 20 times that, well, historical cost is what dictates where we're there, but there is a higher value. And so the market value is much higher than the book value. So to be aware, and there's a little chart here I'm going to show you. If we're looking, typically book value is at least double market value for S&P Standard & Poor's 500 companies. Gives you an idea. It's actually gone up closer to 3 times in later years, 2017, 2018, versus 2 times right after the recession of 2007, 2008. But again, market value, market to book value, double and triple. So market value is usually higher. Let's keep going. Let's go a deeper dive. We'll take a look at the income statement. We know what's on an income statement: revenues, expenses, and net income. This is a multi-step income statement. There's single step and multi-step. Multi-step includes a gross profit calculation. And you can see here we've got net revenues, not gross, because sometimes people return stuff. That's not a sale. Sometimes we give cash discounts for early payment. We're never going to see that money. We have to get net revenues or net sales. And again, accountants seem to use all kinds of terms for the same thing. So sales, revenues, whatever you want to call it. Cost of goods sold, or as they say, cost of sales, or cost of revenue, or cost of product sold. That's the actual cost of the goods we bought at the cost for those goods, not including our accounting department, not including our building depreciation, not including our utilities. Those are more of operating expenses. So revenues minus cost of goods sold is gross profit. Take out our SG&A, selling, general, administrative, or operating expenses to get operating profit. Then we have a few other things. non-operating expenses, and non-operating revenues. These are things outside the norm of our mainstream business. Then we have income tax expense, income from continuing operations, and then we have discontinued operations. We might stop producing some stuff. We might have some other divisions that we've sold off, and we might have gains or losses associated with that. So we have a net of tax effect on that. And then we have our bottom line, also known as net income or net earnings. So when we do something like earnings per share or return on assets or net income or net profit, that earnings, return, or profits are all the same number. They're the bottom line on our income statement. Accrual accounting, not cruel, accrual, is where we're matching. We match revenues and expenses. That's why we don't move our inventory off of our assets, off of our balance sheet until we sell it. So if Best Buy sells a TV, we got, let's say, $1,000 TV in revenue. We have an $800 TV out of inventory. We have a gross profit of $200 on that TV. We still have to pay utilities, salaries, and all this other good stuff, rent. But our gross profit is $200 out of that. But then we have to deduct everything else to get to net profit. But revenue recognition, there are rules, and there have been recent changes in the past 2-3 years about revenue recognition, and expense recognition. So revenue says when we know the amount, when we're pretty sure we're going to get it, we don't have to get the cash. It's not cash basis. It's accrual accounting. We just expect to get it. The money is owed to us. The ownership has changed hands. You've got the TV. You've got the vehicle. You may still owe money, and you're going to write the check for it, or you're going to pay for something, or the bank's going to transfer funds. But you're pretty well assured you're going to get your money. That's when you can recognize revenue. Expense recognition is about all matching. It goes with that. So recognize expenses when incurred, but they may not associate with a cash payment. Okay. Expenses recognized sometimes when cash is paid, or sometimes cash is paid in advance and the expense is recognized later, or sometimes the expense is recognized now and the cash is paid later, that accounts payable stuff. So we'll see how that pulls together a little bit more. Revenue there's a performance obligation. We've actually transferred the goods. It's not in our control anymore. It's yours. You own it. We better get paid, though. We expect to get paid. We got a pretty good idea how much it is that's going to be coming to us. And then we may or may not be at the same time as cash received. Usually, a grocery store, do a drive-through McDonald's. You don't just say, put it on my tab. You say, hey, here's the cash. Here's my credit card. By the way, credit card is considered cash. You say, oh, that's credit, isn't it? I get paid in 24 hours, maybe 48 hours, most of the time 24 or less. But so we call it cash. Any credit card sale is a cash sale. Here's our income statement, back to the same picture, general structure. You've seen that before. Then there's this thing called discontinued operations. Happens all the time. All right. We get that out of our operations because we're no longer going to see that revenue stream. That's not part of our normal business anymore. Okay. And then there's net income or loss prior to the sale. So we discontinue operations, but we're still selling stuff. We're either making or losing money. And then we actually sold it. We have a gain or loss. We segregate that on our income statement below that line, below operations, because again, it's now outside of operations. And then we have that common size or vertical analysis, common size income statement, where net sales is the 100% number and everything else is indicated as a percent of net sales. Gross profit percentage, cost of goods sold percentage, SG&A percentage, bottom line net income percentage. When we look at our 10Ks, we get 3 years of income statement data and 2 years of balance sheet data. That's typical on an annual report. And we'll see that. We're going to maybe need a couple of balance sheets sometimes when we do some of these analysis. There'll be some ratio analysis later on. 2 important profit margins. Gross profit. Okay, so I have sales, net sales minus my cost of goods sold equals gross profit. Oh, so the stuff I sell, the cost of the stuff I sold, that's the top line of that's a profit number, gross profit. And then I've got my operating expenses. I deduct all that and I get to my income from operations. So we've got operating expense margins to go with that. Okay. And then we'll look at stockholders' equity and statement of cash flow. Those are the other 2 statements we're worried about in the terms. So we have common stock and additional paid-in capital. We explained that already. We have retained earnings, increased by net income and decreased by dividends, as well as stock repurchased and retired. And then that other OCI, remember those letters, OCI, other comprehensive income, increases and decreases by change in an asset and liability fair market values that are not reported on the income statement. Well, why don't we report them on the income statement? Well, we haven't sold them yet. The value has gone up. Apple stock skyrockets. Tesla stock goes up or down. But if, let's say, it goes up, we have gains, and you as an investor would want to know about those gains. But we can't report those gains because we use historical cost, and it's going to say, well, when we sell it, we know we have got a number we can hang our hat on. Yeah, you say, well, I know what Tesla's trading for today in the stock market. I can put that on the books, fair market value. And there's some gap that actually will justify that depending on the intention of what you're going to do with that stock. But just think of it like, well, historical cost is a number I can hang my hat on. And until I sell it, I really don't know how much I'm going to make. So we do record other comprehensive income because you as an investor want the big picture, the full picture, a full understanding of what's going on. Then we have the statement of cash flows. Okay, so income statement, GAAP. We're going to be from products sold, from the operating cycle of what's going on. Statement of cash flows is where we get our cash and where we spend our cash. And you can make all kinds of money, gobs and gobs of money on an income statement, but if you don't get paid, you're going to close your doors pretty quick. So what goes on? We have operating, investing, and financing. I can't think of a good acronym other than OIF. OIF. Remember OIF. Cash flow from operations. That's from what we do. That's our current assets and current liabilities. Cash flow from investing. That's our fixed assets, typically, our non-current assets. We're going to buy equipment. We're going to invest in other companies, or we're going to sell some other companies that we own, that we've invested in, or sell some of that equipment, some of the long-term assets. And then financing is the borrowings, debt, long-term debt, because current debt is accounts payable and things is from operating activities. But long-term debt, the bonds we issued, as well as the cash we receive from investors, that's considered financing activities. And then we look a little deeper, and we have the linkages of the four statements. And we're looking and saying, okay, they do link together. How do they connect? Where do they connect? Well, cash on a balance sheet better connect to your cash flow statement, bottom line. How much cash do we start with? How much cash do we end? They're going to show. Our net income, we've seen linking to the balance sheet through retained earnings. So if we look at the big picture, here's our four statements. And I'm going to expand that a little bit. Okay, so we got a balance sheet. We got cash showing up on the statement of cash flow, cash balance in the beginning, cash balance in the end, operating, investing, financing, a change from the year. Okay, that change is going to match. We have our contributed capital, retained earnings, all coming from a statement of stockholders' equity and an income statement. So we have our net income showing up. We have also our balance sheet, pulling it all together. Beginning balance sheet, ending balance sheet, and the relationships in the middle. Okay. And finally, we're going to take a look at information from public sources, lots of tools. We've been talking about the 10K, the annual report. 10Q is a quarterly. It's a 10-K when we looked at Edgar before. There are other tools and other reports. The 8Ks I'll mention specifically, basically any changes that are happening. There may be impairments of assets. Maybe there's a fire. Or maybe there's the new CAT scan machine that replaces the one that takes 6 people to operate, now only takes 2. And it took originally power of $10,000 a month in electricity. Now it takes $1,000 a month. Is that going to impair the value of our original CAT scan machine? Yeah, it's not going to be worth as much, and we might try to ship it out or replace it because it's going to be so much cheaper to operate it, and in a year or two, we get our payback on that. Okay. Company control, executive officer changes, any major changes. We're laying off people. Again, investors are going to want to know that. So the 8Ks describe that kind of stuff. And other information sources, analysts, buy recommendations, sell recommendations, hold recommendations. Those all come from the analysts when they're looking at a stock. Are they right? Sometimes. Are they wrong? Sometimes. Can they make forecasts? Can they make guesses? I mean, everybody makes a guess. Let me ask you a quick question. If I told you that I just laid off 10% of my workforce, does my stock price go up or down? The answer, 2 words. It depends. If I'm laying off that force and you as an investor say, oh, you're going to save gobs and gobs of money and be much more profitable, cool. I think I'll buy more stock. I think you're going to be in the good in the future. If you're laying off people because you're scrambling and you can't afford your people, it's a sign that you're in deeper doo-doo. You may not be doing so well. Maybe the stock price goes down. How about if you have actually increased your sales 10% and your profits are up 20%? Did your stock price go up or down? That sounds pretty good. But what happens if the market expected you to increase your sales 30% and increase your profits by 20%? That's a disappointment to the marketplace. If you're only 10% increase in profits and 20% increase in sales, you did not meet expectations. Your stock price is likely to go down. Stock pricing is all about expectations, future expectations. How about credit reports? There's credit analysts. There's all kinds of credit folks out there, Abercrombie Fitch for insurance. You got Standard & Poor's. You've got Moody's, bond ratings, stock ratings. You've got all kinds of credit worthiness to determine what are those bond payable rates going to be. Can I issue bonds at 5% or 8% or 12% or junk bonds, 15%, 20%? Do people think they're going to get paid back? How risky am I to loan money to? So that's food for thought. And then final slide, brief conversation or brief mention of IFRS, International Financial Reporting Standards. Over 100 countries use IFRS. IFRS is a little bit different in each of those countries. Japan, Europe, most of the European countries, Canada, IFRS. US GAAP, we need generally accepted accounting principles, and they're more similar than difference, but IFRS overall tends to yield a higher profitability and tends to be more fair market value oriented than GAAP. GAAP is a little more historical cost oriented. The also things that go with IFRS, in addition to usually being higher income as a whole, is that they are more concept-based, where GAAP is more rules-based. So rules, you follow rules, you get to these numbers. IFRS says I can make some interpretations, and I've got a little bit of fudge, a little bit of play to go with. So that's our overview of GAAP versus IFRS, and then they have the same definitions. They have assets, liabilities, but their balance sheet's backwards, according to, who's to say what's backwards? Is driving on the left side of the road backwards from right, or driving on the right left? It's kind of fun to drive on the left side of the road with a stick shift and going at it versus the right side. It gets confusing depending on if you're used to one and not the other. So I was driving in Pakistan, and sure enough, I was sitting on the right hand side and doing the stick shift, and it was India, Pakistan, England, Japan, they drive on the opposite side of the road that we do here in the US. So it's just different. So they start with their non-current assets. That's what the IFRS shows, where balance sheet current assets is what we show on GAAP. Okay. And GAAP requires 3 years of data on the income statement. IFRS is only 2. We mentioned that earlier. Balance sheet's 2 years on GAAP. And then IFRS classifies expenses by function, cost of sales, SG&A. By type. And so the appearance, the same terms, but the appearance is a little bit different. So those are some of the tools and a little bit more detailed descriptions that will help you understand what we're using, what we're doing, and where we stand. Look forward to our next conversation. Thank you for listening. If I can help, I look forward to contacting and being in touch directly with any questions you might have. Thank you for the opportunity, and we will look forward to seeing you again soon. Have a good one.